The bear case: structural risks and execution debt. The most significant long-term threat to the bullish narrative is the continued decline in global birth rates. In the United States, the birth rate is at its lowest level in 3 decades, and markets like China and South Korea are facing even more severe demographic contractions. This is not a cyclical trend, it is a structural shift that directly shrinks the user base for Kimberly-Clark's most important products. In 2024, the global diaper market saw volume growth of just 0.04%. While Kimberly-Clark has been successful in driving volume through share gains, the total pie is not growing. Bears argue that the company is effectively fighting for a larger slice of a shrinking cake. Furthermore, as economic pressures like the rising cost of living persist, parents may reach a breaking point where they can no longer afford to trade up to premium 30-cent diapers, potentially reversing the mix gains that have supported the company's margins.
Financial fragility and leverage concerns. The acquisition of Kenvue will leave Kimberly-Clark with a heavily leveraged balance sheet. While the equity component of the deal is significant, the company will still carry a high debt-to-equity ratio, which stood at 477.23% at the end of fiscal 2025. Institutional analysts have expressed concern over the negative outlook assigned by S&P Global Ratings. A downgrade to the company's A credit rating would increase interest expenses and reduce financial flexibility at a time when the company needs to invest billions into integration and restructuring. Furthermore, the current dividend yield of nearly 5% is viewed by some as poorly covered by earnings and free cash flow during this intensive capital expenditure cycle. If the Kenvue integration encounters any significant hurdles, the 54-year streak of dividend increases could be at risk. The Tylenol litigation black swan. By acquiring Kenvue, Kimberly-Clark is also acquiring its liabilities. Kenvue is currently embroiled in high-profile litigation relating to Tylenol, acetaminophen, and alleged links to autism, as well as ongoing talcum powder claims outside North America. While management has characterized these risks as manageable, the history of U.S. product liability law suggests that mass tort litigation can be unpredictable and devastating to corporate valuations. A multi-billion-dollar settlement or an adverse court ruling could derail the entire financial logic of the Kenvue acquisition.
Competitive intensity and private label resurgence. The decision to exit the private label diaper business in the U.S. was designed to improve margins, but it also ceded the value end of the market to competitors. As inflation continues to squeeze middle-income consumers, there is a risk that shoppers will switch to retail brands like Walmart's Parents' Choice or Amazon's Mama Bear that are as much as 20% cheaper than Huggies. In the tissue segment, where the company still operates in the U.S., Kimberly-Clark remains vulnerable to the commodity trap. Products like Kleenex and Scott often lack the science-backed differentiation found in diapers, making it difficult to raise prices without losing significant volume. The loss of distribution in certain club channels in early 2026, projected to be a 60 basis point revenue headwind, illustrates the constant pressure the company faces from powerful retailers. The bull case: catalysts for a pure-play re-rating. The bullish thesis for Kimberly-Clark posits that the market is currently undervaluing a high-conviction turnaround story. By shedding commodity-sensitive tissue assets and acquiring the world's leading consumer health platform, KMB is positioning itself for a structural increase in both growth rates and valuation multiples.
The Kenvue acquisition, transforming the perimeter. The definitive agreement to acquire Kenvue Inc. for $48.7 billion is the most significant strategic move in the company's history. Kenvue, which was spun off from Johnson & Johnson, provides Kimberly-Clark with an immediate leadership position in the global health and wellness sector. The acquisition adds iconic, science-backed brands like Tylenol, Neutrogena, Aveeno, Listerine, and Band-Aid to a portfolio that already contains Huggies and Kotex. The strategic logic is centered on consumer complementarity. For example, the combined entity can now serve a parent from the prenatal stage through the entire infant care journey, offering everything from maternal health products, Kenvue, to diapers and wipes, Huggies, and skincare solutions, Johnson's Baby, Aveeno. The financial architecture of the deal is also notable. Kimberly-Clark is using a large equity component, valued at approximately $34 billion, which limits the immediate deterioration of credit metrics and preserves financial flexibility. S&P Global Ratings analysts have observed that while pro forma leverage will approach 3.0x, the planned $2.1 billion in annual synergies should reduce this to 2.3x within 24 months of the close.
The Suzano joint venture, de-risking the tissue segment. While expanding into health, Kimberly-Clark is simultaneously reducing its exposure to the volatile and capital-intensive international tissue market. The partnership with Suzano SA, the world's largest pulp producer, is a strategic hedge against commodity cycles. Suzano will pay Kimberly-Clark $1.734 billion for a 51% stake in the newly formed International Family Care and Professional (IFP) joint venture. This entity will manage consumer tissue and professional products across 70 countries outside the U.S. For Kimberly-Clark, this move is brilliant in its simplicity. It removes the heavy capital expenditure requirements of international paper mills from the consolidated balance sheet, while securing a long-term, low-cost supply of fiber for the remaining 49% stake. Furthermore, the deal allows Kimberly-Clark to monetize its legacy tissue assets to fund the high-growth Kinview acquisition.
Innovation and the powering care engine. A critical component of the bull case is the success of the company's internal innovation engine. In 2025, 78% of the company's volume and mix growth was attributed to products launched in the previous 3 years. Management has moved from a fragmented regional R&D model to a streamlined system of 11 scalable global benefit platforms. Specific innovations that drove market share gains in 2025 include Huggies Cloud Waistband. This premium feature in North America focuses on skin health and comfort, contributing to a 100 basis point share gain in the region's diaper market. Kotex Gravity and BioCare Technologies. These advanced absorbent platforms were central to the U.S. relaunch of Kotex, helping the brand defend its 1 or 2 position in 70 global markets. Deep Sleep Master, China. A specialized overnight diaper that led to a 210 basis point share gain in China's high-margin, top-tier diaper market. This ability to premiumize the portfolio is essential for navigating the baby bust. If birth rates are declining, the company must extract more value from every birth, a goal that these science-backed premium innovations are clearly achieving. Operational efficiency, the FORCE program. Kimberly-Clark's transformation is self-funded through an aggressive cost-cutting regime. The company exceeded its 2025 gross productivity target of 5 to 6%, achieving 6.2% for the full year and an impressive 7.2% in the fourth quarter. These savings are not merely about cutting costs, but about fundamentally rethinking the global supply chain. The company is optimizing its network into mega plants, such as the new $800 million facility in Warren, Ohio, which is expected to reduce distribution miles on the road by 22% and significantly lower conversion costs.
Company Deep Dive. The reported net sales for the full year 2025 were $16.4 billion, a decline of 2.1% from the $20.1 billion reported in fiscal 2024. It is imperative to note that this nominal decline was primarily driven by strategic decisions rather than a failure of brand resonance. Specifically, a 2.9% negative impact was attributed to the divestiture of the personal protective equipment business and the deliberate exit from the low-margin private label diaper business in the United States. While the reported top-line figures showed contraction, organic sales grew by 1.7% in 2025. This growth was fueled by a robust 2.5% increase in volume and product mix, which was partially offset by price investments of 0.9% as the company sought to enhance its price-value tiers across the global portfolio. This shift from price-led growth, which defined the 2022-2023 inflationary cycle, to volume-led growth, is a central pillar of the bull case, suggesting that the company's innovation pipeline is successfully driving consumer preference. Profitability and margin dynamics. Gross margins in 2025 were a focal point for analyst debate. The reported gross margin of 36.0% included approximately 130 basis points of charges related to the 2024 transformation initiative. Excluding these one-time costs, the adjusted gross margin stood at 37.3%, representing a 100 basis point decline from the prior year. This margin compression resulted from a deliberate strategic choice. Management chose to reinvest significant portions of its industry-leading productivity into marketing, R&D, and lower price points to defend and grow market share in a softening global consumer environment.
By the fourth quarter of 2025, however, the benefits of the FORCE, focused on reducing costs everywhere, program began to accelerate. Adjusted operating profit for Q4 rose 13.1% to $629 million, driven by strong productivity gains that reached 7.2% of adjusted cost of goods sold in that quarter alone.
Kimberly-Clark's performance is intrinsically linked to the price of wood pulp and petroleum-based resins. The 2026 outlook for these inputs suggests a choppy but manageable environment. The fiber cost curve. The global pulp market is currently a supply-driven story. While demand from traditional paper grades is in secular decline, demand for hygiene grades, tissue and diapers, remains the primary growth driver for the pulp industry. Fast Markets analysts note that while hardwood pulp prices have likely found a bottom, softwood remains volatile due to Canadian sawmill curtailments, which have reduced the supply of residual chips. For Kimberly-Clark, the Suzano joint venture acts as a crucial moat. By partnering with the world's lowest-cost producer, KMB's international operations are shielded from the pricing power of the merchant pulp market. To determine if KMB is a bargain or a value trap, it must be compared against its direct competitors. Kimberly-Clark is trading at a roughly 35% discount to Procter & Gamble and a nearly 50% discount to Colgate-Palmolive on a forward PE basis. Bears would argue that this discount is justified by Kimberly-Clark's higher debt, lower growth, and the risks of the Kenvue merger. Bulls, however, see this as a deep-in-the-bargain-bin opportunity. If KMB can successfully integrate Kenvue and achieve its 20% operating margin target, its multiple should expand to at least 20x, implying significant upside from current levels.
Dividend sustainability. On January 27, 2026, the company announced its 54th consecutive annual dividend increase to $1.28 per share. However, the TTM payout ratio of 103%, calculated on reported earnings, has raised eyebrows. Management's argument is that the payout is well covered by adjusted earnings and that the current mediocre cash flow is a temporary result of the transformation charges. For fiscal 2026, the company targets $2 billion in adjusted free cash flow, which would provide roughly $1.7 billion for dividends and $300 million for debt reduction. This leaves very little room for error. Conclusion. The bull case is rooted in the belief that management is executing a masterclass in portfolio reshaping. By divesting the commodity-exposed tissue business and acquiring the high-growth, high-margin Kenvue platform, Kimberly-Clark is structurally improving its earnings quality. The current valuation discount represents a rare opportunity to acquire a dividend king at the start of a massive re-rating cycle. The company's 7.2% productivity performance in Q4 2025 suggests that the FORCE program is a powerful engine that can fuel growth even in a difficult macro environment. The bear case remains concerned with the law of gravity in demographics. No amount of innovation can fully overcome the structural decline in birth rates, which creates a permanent ceiling for the diaper business. Furthermore, the Kenvue acquisition is fraught with execution risks, significant debt, and the known unknown of Tylenol litigation. The 5% dividend, while attractive, leaves the company with a very thin margin of error as it navigates the integration process.